Welcome to OptionsPlay. In this video, I'm going to share with you a massive backtest that we just completed on the Nasdaq-100 and the S&P 500 for technical indicators and option strategies. I want to share with you the best technical indicators to use when trading indices that have been backed by 21 years of data and how to structure optimized option strategies based on the last 7 years of data. Let's get started. To start, we're going to explore the technical analysis backtest and the indicators first. But before we dive into the data, I want to show you how we set up the backtest. We started this project by calculating a benchmark first. We randomly selected 1,000 different dates from the past 21 years and calculated the win rate and average return of the equity market over 7, 14, 21, 30, and 45-day periods. This benchmark allows us to see if the indicators that we test can beat the market. Remember, it's not good enough that an indicator wins more than just 50% of the time, because over a 30-day period, the Nasdaq-100 averaged a return of 106 basis points and was up 63.8% of the time. And the S&P 500 returned 74 basis points and was up 65% of the time. Using this data, we were able to test buy signals on technical indicators and calculate how well that each performed. Our backtesting offered 6 very interesting insights on both the Nasdaq-100 and the S&P 500. The first observation that we made that jumped out to me was the absolute return. Using the same indicators, the Nasdaq-100 outperformed the S&P 500 by 15 basis points. Moreover, the outperformance on NDX was greater than SPX over their benchmarks. In our testing, trades with holding periods of 30 and 21 days had the highest outperformance over the benchmark using technical indicators. RSI crossing the 30 oversold threshold was by far the best performing indicator for both the Nasdaq and the S&P. However, it was a very rare signal, but it did produce returns that typically were more than double the benchmark. Now, I often receive the question regarding which moving average is best. While the best moving average is always going to depend on your holding period, we did find that exponential moving averages perform better for indices over simple moving averages. We also found that longer EMAs, 100 and 200 days, also perform better than shorter period EMAs, even over a shorter holding period. This is likely due to the number of publications and investment managers that track these important moving averages and use them to time entry signals. But most importantly, our observations saw that despite strong win rates and substantial returns, even the best indicators had a surprisingly high number of consecutive false signals. And this simply further emphasizes the importance of risk management when using a technical strategy. Armed with this data, which showed us that using technical analysis can be used to outperform the market, we then tested popular option strategies using various expiration dates and strike prices to determine the optimal strategies to trade index options on the Nasdaq-100 and the S&P 500. We ran a total of 210 backtests on both the NDX and SPX over the past 7 years of historical data. And we tested 4 popular option strategies: long calls, short puts, long debit vertical spreads, and short credit vertical spreads, to find the performance and optimal settings for each one. We found some very insightful metrics for options traders to be familiar with when selecting an optimal option strategy. Buying an out-of-the-money call option provided the highest absolute return, a very popular strategy. However, it also had the highest volatility and risk. 60 to 65% of these trades actually ended in a loss, where just a few quote-unquote home runs turned these strategies profitable. So it's important to understand that these strategies suffered through a long losing streak of 27 consecutive losing trades. That's tough to come back from. Versus buying in the money call options, on the other hand, had slightly lower absolute return. However, it had 62% winners, and the highest win streak had 17 consecutive winning trades with only 8 consecutive losing trades. To combine the best of both worlds, buying a debit vertical spread provided absolute returns that were almost as high as buying out-of-the-money calls with far smaller risk and about a 60% win rate. This really shows you how vertical spreads help combine the best of both worlds with returns similar to buying out-of-the-money calls, but having win rates and risks that are closer to buying in-the-money calls. Short puts had by far the highest win rate, 80 to 81% of trades. However, this is also the strategy that had the lowest absolute return and suffered through some of the largest drawdowns despite generating a very consistent and stable income stream. Selling a put credit vertical spread was able to improve on short puts with higher returns and lower drawdowns, while only reducing the win rate from about 80% to 77%. Moreover, short put credit spreads on indices suffered through the smallest losing streak of any strategy, with only 4 losing trades in a row. So to summarize, spreads were able to maximize the benefits of buying calls and selling puts while minimizing the risks and trade-offs of each strategy. Trading technical and option strategies may sometimes feel like there's an almost infinite set of possibilities, so I hope that this information is helpful to help point you in the right direction. If you're interested in the full backtesting report or recording of the full webinar that I've hosted on this topic, I'll leave the links in the section below. If you enjoyed this, please subscribe to our channel and like this video. It really helps us. And don't forget to hit the notification bell so that you'll receive a reminder the next time I upload a video in this series. And please, let us know how your experience with trading using technical strategies, which indicators work best for you, and what option strategies you've had the most success with. With that, thank you so much and have a great trading day.